to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day, so let's get to the three market catalysts we're watching this hour. First up, JPMorgan reporting fourth quarter earnings. We've got the top takeaways, plus Nvidia and Eli Lilly teaming up to build a $1 billion AI-powered drug discovery lab, what that could mean for the price of drugs in the future. And a new report highlights the best jobs in America in 2026, what careers are positioned for long-term mobility and security in the future. We'll tell you. Let's take a look at the major averages here. We got a mixed picture today. We had that CPI report that came in at the core level a little bit milder than had been estimated. Initially gave a little bit of a boost to stocks, but that's pretty much faded away as the attention turns to earnings and some of the other things going on in the market. Right now, the Dow's lower by almost 300 points here. That's about a 0.6% drop. The S&P 500 off by 0.1%. The Nasdaq very little changed here. And looking at some of the different assets that we're watching in the wake of the CPI report, we're seeing yields very little changed here. So in other words, not a lot of read through on the part of investors as to a changing prospect for the Federal Reserve changing interest rates going forward, at least not in the short term at the January meeting. So the CPI not really moving the needle on that. One thing that is moving a little bit more today, we're seeing crude oil futures pushing above $60 a barrel. That's because of the increased prospect, or at least the possibility as seen in the eyes of the market, of some kind of intervention in Iran and the possibility that that could disrupt oil prices there. So that's something we continue to watch. At the same time, gold continues to move higher as well. Now, digging into what's going on in the S&P 500 today, that higher oil price can pretty clearly be seen here. The XLE, the energy ETF that tracks the energy stocks, is doing the best in the S&P 500 today. Consumer staples in the number 2 position. Financials are falling today, and that's as we are starting to get those bank earnings. So here's a look at how the banks are doing, the bank heat map here. JPMorgan coming out of the gate. We're going to dig more into this in just a moment, but right now it's down 2.7%, even though overall numbers beat estimates, but there were some details that were not as good perhaps as the market wanted, so we'll take a look at that. At the same time, the other company, the other bank out with numbers this morning was Bank of New York Mellon. Those shares little changed, although it too did beat estimates. And just quickly here, going back to the Dow, which is the underperformer today, JPMorgan is certainly a part of the picture there, part of the reason behind that. We're also seeing Visa shares sharply lower, so we'll continue to look into that. Salesforce, it looks like, also under pressure today. Caterpillar doing the best in the Dow. Let's dig into, as promised, what's going on with those bank earnings here, and specifically JPMorgan. Those shares turning more sharply lower now, 2.6%. JPMorgan did report lower than expected revenue for its investment banking business. At the same time, it sees annual net interest income rising to $103 billion in 2026, ahead of estimates. CEO Jamie Dimon also addressed the Department of Justice's investigation into Federal Reserve Chair Jerome Powell. He warned that eroding Fed independence could push rates higher. For more, let's bring in Saul Martinez, HSBC head of U.S. Financials Research. And Saul, just to set the table for people who are watching, you have a reduced rating on JPMorgan, which means you are not positive on the shares. Did this report validate that view in some ways?
Yeah, and thanks for having me on. I think the reaction to the results validates the reduced rating, because the reduced rating really is a reflection of the view that we think a heck of a lot of positive news is priced in. And the results were good results overall, and you're seeing a reaction that is negative, which to us tells you that the expectations are exceedingly high with a valuation of it over 3 times tangible book value. Now I'm sure we'll go into some of the details here, but the results were a little bit ahead of our expectations in terms of EPS. Core trends were good. I would categorize this result as good, not great. Investment banking was a little bit soft, although that seems to be transitory, and the outlook for investment banking is positive next year. They did not change their 2026 guidance for core net interest income. You gave the $103 billion number, that's the reported, but the core number that really impacts earnings, that was not increased, and perhaps there was a hope that would be increased, and that guidance was, is a little bit conservative. But when your stock has been on fire, there's a lot of positive news flow about regulations, and earnings have been good. It takes more to get the stock moving, and I think the reaction to the result, what are pretty good results, is telling in that respect.
At the same time, as you look out through the balance now of 2026, and you look at that outlook for net interest income, you look at the prospects for investment banking, do you think now that it sets it up for them to come out and kind of beat some of those estimates? I mean, where is there room for upside?
Yeah, it's a good question. I think there's, I think there may be some conservatism in the net interest income guidance. They did roll out some of the underlying assumptions there to rate cuts. That's probably fair. Modest balance sheet growth. I think there's potentially a little bit of upside there. They are expecting some compression in the margins or the spread they make on deposits. That might be a little bit conservative. So net interest income is an area where perhaps they can they can exceed their guidance. But I would say, Julie, even though consensus numbers are probably pretty much in line with that guidance, I think there has been perhaps a sense that JPMorgan guides very conservatively. So even if you were to come out a little bit ahead of those expectations, doesn't necessarily imply that the stock will react in a materially positive fashion.
Gotcha, because investors are sort of used to that, I guess,
Yeah,
in a way.
I think that's probably fair, yeah.
I'm curious what you make of the deal for the Apple Card, the company taking a charge of about $2.25 billion related to that in this quarter, and they're not going to take over the Apple Card, for 2 years. Do you think that was a good deal for them?
Yeah, I think there is a lot of news flow around cards these days, but yes, I think this is a situation when you think about M&A, the transaction makes sense if it's to happen if it's worth more to the buyer than the seller, and I think this is clearly the case here with Goldman and JPMorgan. This really does round out their cards business. JPMorgan is very, very strong in the high net worth or the premium reward space, the premium space, and this does give them a more balanced cards business. Partnering with Apple is obviously obviously has some benefits. You do get access to a number of clients that you can perhaps cross sell into, and they just have more scale in this business than a Goldman Sachs does. So it's a business that is more likely to be profitable in the hands of JPMorgan. So I do think it makes sense. There is it will take some time to integrate that portfolio, 2 years, but I do think strategically it makes some sense, and it is a business that if you run it right, it is a high margin, high profitability type of business.
And speaking of credit cards, as you said, there's been a lot of news flow there. CFO of JPMorgan, Jeremy Barnum, said on the call that it would be very, very negative if this 10% cap went into effect. How negative have you gone so far as to sort of try and quantify what effect that would have on JPMorgan and the other banks?
Yeah, I wouldn't. We published on this. We haven't quantified it. I've been a little bit careful about putting numbers around this, given the uncertainty, given a lot of uncertainty about this. Not just whether it happens, and there are some questions about how it even could be implemented legally, but also what the details would be. Would this be on all of the portfolio today, or would it just be on new origination? Would have a sizable effect. What I would say here is that the impacts would be very, very sizable. A 10% interest rate cap makes a very sizable part of the cards business unprofitable, and would mean lenders would, probably not provide credit to, large numbers of borrowers. It would be much more negative, obviously, for some of the consumer finance companies, and you saw that in the reactions yesterday, Capital One and Synchrony, where, you can run math that is pretty, devastating to earnings. From the banks, it is relevant. I mean, JPMorgan, cards are roughly about, roughly in the low mid-teens in terms of revenue contribution. But it does really change the nature of the business, and it would certainly have a material impact on earnings. That said, JPMorgan is so diversified and so profitable across the businesses that they could probably withstand it more than others. Of the other banks, Citigroup would probably be the most affected. The cards are about 20 to 25% of revenues and loans, so they would be, impacted, and they have a big retail services business that would be, or a partnership business with retailers that would be impacted. So I'm hesitant to really quantify in specific terms, but it would be relevant, and it would have a not immaterial impact on profitability for some of the big banks.
Saul, we're showing not just JPMorgan, but some of the other bank stocks and how they're doing, and they're down broadly. Do you think JPMorgan has implications for the other banks? Does it sort of predict what some of the tone around some of the other numbers?
Yeah, I think there's probably a couple areas where it is, there is some implications. And generally, I wouldn't say they're bad implications. I think, like I said, underlying trends were generally pretty good. The loan growth picked up, NII was good. Deposit dynamics were positive, credit was positive, tone on the economy, generally positive. So all that's, relatively good. But, I think in the areas where it could be impactful or more direct, obviously the consumer finance business for cards, that in general, putting aside the policy dynamics, that was pretty good. Credit growth was fine. And that's a positive read through for Citi. And on the capital market side, though, it's a little bit more mixed. And keep in mind, Goldman has had a massive run, as have Morgan Stanley. The markets, the trading businesses were very good. That's a good read through, but investment banking was a little soft. It sounds like it was more pushing activity out into next year. So if that's the case, that it's more of a transitory thing. But again, the expectations are so high for some of these companies that, unless you have a really, really strong quarter, there may be, some disappointment. The only other thing I would mention beyond sort of the results dynamics is just the policy dynamics right now, which I think are sort of is an overhang here. And this is something we highlighted in our 26 Outlook report as a key risk to the sector. I think investors have grown to view policy as sort of a one-way dynamic towards deregulation and factors that are beneficial to banks. And I think some of the news flow over the weekend, the rate cap, social media post, and concerns about Fed independence have now, have called, maybe have had an impact perhaps on that view and reminded investors that policy changes can sometimes be risks as well. So I think that is hitting sentiment a little bit on the banks.
Yes.
Also.
Fair to say, I think, Saul. Thank you so much. Good to see you.
All right, anytime. Thanks for having me.
Coming up, we'll look at some of today's trending tickers and top analyst calls. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ. Let's turn now to some of today's top analyst calls on Wall Street. Today, we're watching shares of Intel, Reddit, and Planet Labs. First up, KeyBank upgraded both Intel and AMD to overweight from sector weight. Analyst John Vinh, who long believed Intel would be better off divesting its struggling foundry, now said the rising yield of its manufacturing process, 18A, showed the business is making, quote, significant progress. He said that's good enough to ramp up Panther Lake, that's a code name for a new chip unveiled at CES. Meanwhile, demand for chipmaker AMD is ramping up. Vinh said the surge in hyperscaler demand has led AMD to almost being completely sold out of server CPU, that's central processing units, in 2026. It's also potentially considering a price increase of 10 to 15% in the first quarter of this year. Next up, Reddit. Evercore ISI said the stock still has more room to run after a 40% increase in the last 12 months alone, initiating coverage with an outperform rating. Now, the analyst said there is significant opportunity for Reddit to grow its average revenue per user. That, alongside recent product launches like Max Campaigns, that's an ad tool that's still in beta, alongside an opportunity to scale non-ad streams. There are currently 21 buy ratings, 12 holds, and 1 sell in the street for Reddit. And lastly, Planet Labs. Wedbush raising its price target on the satellite and data company to $28. The firm said it continues to see, once again, significant demand in government across both the U.S. and international markets, while also seeing further tailwinds from AI leading to growing use cases. The analyst, Dan Ives, went on to say that it's well positioned at the intersection of space and AI to capitalize on the rapidly growing market, and the average 12-month price target is about $23. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout the session.
Now time for some of today's trending tickers. We are watching Microsoft, US Bancorp, and Tesla. First up is Microsoft, the company trying to get a step ahead of the rising criticism over data centers and electricity costs. The tech giant making promises to consumers, especially those who live near data centers, saying they won't pay more for electricity. Microsoft will replenish water and add to local tax bases where it operates data centers. This coming on the heels of President Trump saying that he was working with Microsoft on some of these issues. Jared Blickery is with me, our markets and data editor. And as you know, there has been sort of a rising drumbeat of anti-data center sentiment kind of around some of these issues.
I mean, my electric bills have been up for quite some time, and I don't know how much is due to AI, but that is the strain on the U.S. consumer right now. So you mentioned President Trump. He said publicly recently that big tech should, quote, pay their own way so that consumers don't pick up the tab. And I think this is likely in response to that. So Microsoft President Brad Smith, he's going to ask utilities and regulators to set rates high enough that Microsoft is going to cover the full electricity and infrastructure costs at its data centers. And it's also about water, because we know that water is a key ingredient in cooling a lot of these data centers. And a lot of people have stopped asking GPT nicely. They stopped saying please and thank you, because every little token just contributes to more water use. But back to the main point, Microsoft is saying it's also about water and transparency. They're going to cut water use and publish regional water data. So their water pledges replenish more water than it uses and then publish that data.
Yeah, so it's interesting to see how this evolves. Some of the utility deals that we have seen, not just with Microsoft, but some of the other Meta, some of them are sort of so-called front of the meter deals. That is, they pay for the upfront costs of the project, whatever it may be, to try to again subsidize away some of the increasing cost of electricity. So it's not necessarily a mover in terms of the stock specifically, but in terms of the longer term trend and some of these big issues around data centers, it's definitely going to be something that investors need to continue to watch.
And in an election year.
Yes, very good point. Next up, let's talk about US Bancorp, the regional bank making a deal to get deeper into the capital markets business. It's acquiring BTIG for $1 billion. Now, US Bank is the largest US regional bank. We've had sort of increased attention on some of these banks because there's some speculation there might be, and there already has been, some increased M&A activity. And this is I believe this is a business that US Bancorp had sort of backed away a little bit from, and so now sort of recommitting to it.
Yes, let's set the stage here. So BTIG is a Wall Street brokerage and investment bank. It is not a consumer bank. They operate in 20 cities across the US, Europe, Asia, Australia. And US Bancorp, meanwhile, is trying to become more than a traditional lender. So they want a bigger slice of that Wall Street fee pie. And BTIG, well, it's going to serve as a plug-in here. So they got a broker and advisory shop that's already worked with US Bank for over 10 years, almost a dozen years. The deal US Bank is paying to fill product gaps. So they fill the product gaps in equities and advisories, that's stocks, and also, these M&A deals, not unlike the one that we're talking about here. And then cross-selling all that to its corporate clients. So, more fees, more revenue. I guess maybe that's what they're looking for here. But I thought we'd go to the Wi-Fi Interactive and take a look at the regional bank heat map that I have up here. This, all these percentages here are the 1 year trailing returns of these banks. And as you said, USB here, I got this in the lower, just a little bit smaller than PNC right now, but they're about the same size. And I'll pull this one up. Here's the 2 year performance. So it's in the upper end of the range, and it just kind of broke out there, and it's testing that high. And if there's going to be a catalyst that can propel these shares to higher prices, maybe it's going to be this merger. We're not seeing a lot of excitement here today. A lot of times what happens, because these these mergers have to be paid, we see the stock, the buyer of the deal, actually go down, and that's what we're seeing right now. So U.S. Bancorp down about 1%. But if Wall Street gets excited about this, they see the synergies, and then a few quarters go by, and it shows up in the earnings. Maybe it will be that catalyst.
It's interesting. I'd forgotten U.S. Bancorp also used to own Piper Jaffray and spun it out back in 2004.
And so they got rid of it, and now they want back in.
Yes, exactly. The other thing to mention in terms of catalysts, they report earnings on January 20th. So we'll be looking for those numbers also. And then finally, let's talk about Tesla. That stock is searching for direction a little bit, even as one analyst who's on the sidelines does see some positive movement for the company. That's Wolf's Emmanuel Rosner. He has a hold on the stock, but he sees EV sales rising 6% this year. It's not all upbeat news, though. He also sees AI costs rising. The shares are little changed here.
Yes, little change. We know that the straight up EV business has suffered a little bit since those tax credits expired at the third quarter of last year. And this is a look past 2026 argument right here. He's looking ahead to robo-taxis, and so the near-term fundamentals admittedly look tough to him, but if full service driving and robo-taxi business, if that matters more at the end of the year than these car margins, well, then maybe we'll see this story play out. So he's basically saying 2026 is a prove-it year for Tesla, wants to see that robo-taxi expansion, wants to see meaningful full service, full self-driving progress, and we'll have to see what happens with the regular EV business, but that's not as much of a factor right now. One risk, big risk, if these autonomy milestones slip again, and we've seen those, Elon likes to make big promises, and so if some of these milestones go unmet, then that could be a wait on in terms of this call right here.
Can we take a look at this one on the Wi-Fi Interactive? Because the Tesla story, stock-wise, has been really interesting. I mean, their comeback from the lows post-Liberation Day was especially acute, right?
Yes.
And so it made a new high, and then it kind of faded a little bit.
Yeah, that's what we call a false breakout.
Okay, I like it.
So you make a new high, you get all the bulls excited, and then you go back inside the trading range. But look, I've drawn this really rough trend channel in here. It's still inside the trend channel. It's still inside a longer-term bull movement. So that was just a short-term fake out. That doesn't mean necessarily anything in the longer-term picture. I would watch 400. Watch this 400 level here. If that fails and the price starts kind of trading below it and using it as resistance, well, that's when you see the new long-term downtrend develop. But in the meantime, things could wander around here. But Tesla does need a new catalyst, and this probably isn't the one right now.
For since we're in earnings season, I'm just going to say everything that we're talking about. I'm going to tell you when the earnings are. Tesla, it's later this month, towards the end of the month. So we'll see if that is the catalyst. I realized I didn't say when the earnings date was for Microsoft. For that, it's January 28th.
Very good. We'll be watching.
We will. All right, thanks, Jared. Coming up, Big Pharma meets Big Tech, pushing the capabilities of future drug discovery. We'll talk about it next with the CFO of Eli Lilly. You're watching Market Catalysts. Big Pharma teaming up with Big Tech. Eli Lilly teaming up with Nvidia to bring forward the learning system for drug discovery. Here to talk about the journey of healthcare into the realm of AI, let's welcome in Lucas Montarce, Eli Lilly Executive Vice President and Chief Financial Officer. Lucas, it's good to see you. Thanks for being with us.
Julie, thank you for having me.
So talk to us about this new lab. You guys are going to, it's a $1 billion lab that will use NVIDIA technology and be teamed up with some of the scientists and doctors there at Eli Lilly for drug discovery. There has been so much talk about AI and drug discovery. Can you explain to us exactly how this is going to work?
Yeah, first of all, this is a real investment that we are doing here in San Francisco. We are going to bring both scientists from the company and also researchers and engineers from NVIDIA, the best talents that we have on both companies together here in San Francisco. You mentioned the total investment up to $1 billion, and we are going to put that not only the investment is on the people side, is infrastructure, but also computing to basically work on the hardest problems that we have in drug discovery to start with. And that's across the entire core therapeutic areas and portfolio that we have. So very exciting. This is building upon the additional investment that we are doing as well. We are building a supercomputer back. This is in Indianapolis. We are building that supercomputer at Corporate Center. That computer will be up and running as early as next month. So exciting time to continue to build upon our journey in AI.
And so, Lucas, so when you say you're trying to solve some of the toughest problems in medicine, what are the toughest problems? What are you guys going to be focusing your energies on?
Yeah, the energy will be focusing, as I said, across all the therapeutic areas. There are, again, challenges on small molecule gene therapies, and it's all driven by how fast, how much you can basically put in a scope or to test, discover in different targets. So this will help us, AI will help us to augment that significantly and go faster, but also look at different combinations in a way much faster way than what it used to be in the past. Still, scientists and our brilliant minds will be very much needed, but again, this will help us to augment that over time.
Lucas, I'm also curious about how it affects the sort of cost equation over time, right? You guys are making this investment in it now on the technology. But if it's going to be faster, or if you're going to have potentially more drugs out there to treat more different things, eventually are you going to see costs overall come down as a result of AI and this method of drug discovery?
I think over time, what you will see, Julie, on this is two fronts. The first one is the one that you alluded, which is basically that we are going to go faster to bring molecules to the market. That's very important when you think about bringing, again, those solutions to the patients globally. That's the main focus of our attention, how we bring more innovation. But also at the same time, you mentioned the cost component. Of course, over time, you may think that, again, this will drive efficiencies as well on how we drive, again, our development focus as well. But the main focus is how we do this faster and bring more molecules to the market.
I want to ask about what's coming down the pike in terms of your weight loss pill, because I know this is a big focus for you guys. It's a big focus for the market. And you have said you expect potentially second quarter approval. Now, this is after your competitor Novo Nordisk got approval for its pill form of its weight loss medication. How do you sort of catch up? When do you expect it to come to market? And how do you bring it to market in a way that's going to compete with the entrant that's already out there?
Yeah, very exciting time. As you know, again, when you think about the obesity space, you're talking about 1 billion patients, and we are just scratching the surface nowadays with injectables. So bringing the orals will give us the scale in my eyes and also convenience of use as well for millions of patients actually to get treatment as well. You mentioned again the competition. I think when you talk about a couple of months, there is not a big difference. In fact, as you know, we are the market leader both in type 2 diabetes and obesity, and we came after the competitor as well. So I don't think that is the one that is going to be driving this, but it's more about how we can address more patients globally and have more options between the injectables and the orals.
So how many patients are on the existing drugs, the injectables that you all have on the market, Montarce and Zepbound? And then with an introduction of a pill, how much more market penetration do you expect to get as a result of that?
Yeah, thinking about the US market, you are talking about basically 120, 130 million patients that you can treat. We are actually penetrating the market in the high single digit here in the US. But OUS, you're talking about more than 900 million patients that we can serve. And the level of penetration that we have nowadays, remember early days, is low single digit. So when you think about scaling, in particular in small molecule, this will bring a solution for patients, for example, in China, India, Brazil, large patient populations that could be served by this oral pill as well.
Well, and I guess what I'm asking is, you know, for people who are reluctant to do an injection or who don't have access to the injection for whatever reason, do you all have estimates as to, you know, what that increased penetration could potentially be?
Yeah, there are many actually benchmarks that you can use in different fronts. I think when you think about this space, you are thinking about potentially reaching in the 20% or so penetration globally. But it will all depend on how much you can continue to drive this growth over time. You're thinking about the small molecules, but we have a pipeline as well. This is the time for the oral pills or Orforglipron, but we have a pipeline and a breadth of portfolio that will bring also different options. We are actually starting to read out our triple-acting retatrutide that will actually, the first study read out back in December, and the weight loss that achieved was 29%, and also a big reduction in basically osteoarthritis pain as well. So there is, again, a big combination in my eyes of bringing more solutions, bringing more options to the patients, to go back to your question about treating more patients globally.
And Lucas, finally, as you mentioned, you're there in San Francisco where you guys are going to be building this lab with Nvidia. And you're there because of the JPMorgan Healthcare Conference, where a lot of executives from big healthcare companies have gathered this week. I'm just curious, be our on-the-ground reporter for a moment, if you would, Lucas. What are some of the themes that you're hearing about? What's the buzz there? What's exciting to you that you've been hearing in your conversations?
Yeah, exciting time at JPMorgan. There is a lot of deal activity. Most of that is in the news already. We signed, by the way, an agreement last week on inflammatory disease with Ventyx. So we are acquiring that and bringing those experts in Ventyx to drive basically more inflammatory solution and diseases across different therapeutic areas. So exciting time from the deal development. Of course, a lot of excitement as we talked about before on AI and these partnerships that we signed with Nvidia as well. And a lot of excitement of where the company is and where it's heading. By the way, it's an special year for us. We are celebrating our 150-year anniversary. So though we are moving and we are having the largest pipeline at this time, we are also celebrating an important time for the company.
Lucas, thanks so much for joining us. Appreciate it.
Thank you for having me.
Thanks. Coming up, mixed results for retailers over the holiday season. We'll take a closer look at where consumers are spending next on Market Catalyst. Early results from retailers are showing a pretty mild holiday shopping season in the fourth quarter. Yahoo Finance's Brooke DePalma spoke to David Silverman, Fitch Ratings Senior Director of Corporates, about the state of retail.
David, thanks for joining us from the ICR conference. I appreciate your time. I do want to get to the first announcement here. Abercrombie really hit a stride back in December. Then we saw a stock off to a rough start this year after cutting that outlook. What do you make of what they had said today? And what does that mean for Abercrombie moving forward? Is their quick hot streak over?
Look, I think that company has continued to show growth. They've had a strong track record over the last couple of years. Fashion companies are going to ebb and flow over time. It's natural to see a fashion company in vogue for a period of time, and then for trends to moderate, potentially turn negative. We see that across the apparel space. Companies are always, as you say, or as I said, kind of ebbing and flowing. So the company's had great momentum. We'll see if they can keep it up over the next year or two.
Another one that got lots of attention is American Eagle. They said that their fourth quarter comp sales were actually up 8.5%, but it didn't seem like it was enough to persuade investors. What do you think this company needs to focus on moving forward to really win over the street?
Yeah, it's a tough one for me to answer in terms of managing those market expectations. I think what's been interesting is overall results, and we saw it this morning, results continue to be pretty okay, across a lot of the discretionary space, despite the fact that, we've seen strong growth across the consumer discretionary space over the last several years, and yet consumer sentiment and some indicators of consumer health, continue to moderate. So, frankly, just the fact that we continue to see positive results and growth out of a number of these mall-based retailers is to us in some ways a surprise.
David, one company that seems like we can't stop talking about is Lululemon, because even though it's up today, it came out with better than expected preliminary results here, saying that it's going to be at the higher end of their guidance as far as fourth quarter sales go. They're in the middle of this proxy fight with the founder. You also have a new CEO, stepping in after the search continues. What do you make of a name like Lululemon and really just the athleisure moment in time that they're up against as competitors really flow into that space as well?
Yeah, again, that company has had, I would say, somewhat of a first mover advantage in terms of the growth that they've seen. We've seen meaningful growth in the athleisure space. What's now happened, a couple of factors. Number one, the growth of athleisure overall has somewhat moderated. Consumers have filled their closets. They're also going back to the office and looking for other forms of dress. We've seen a number of other competitors kind of come into this athleisure space, and we've also seen Lululemon work on expanding their offering, which then puts them at competing with other types of retailers. So in part, it's what I noted before about to some extent the ebbs and flows of apparel segments and individual apparel brands.
David, something that I feel like I heard a million times in 2025 and now I'm hearing to kick off 2026 is the word value. And one of those players that were winners today is Five Below. It raised its outlook. What do you make of value moving into 2026? And will this K-shaped economy continue to persist?
Yes, value is absolutely in vogue. We've seen that kind of across the retail landscape. Value-oriented retailers, whether they're names like Five Below, whether they're off-price, whether they are a Walmart. Customers in somewhat of a tough economic environment are looking for value. That's likely to continue in 2026. We don't see significant improvement in the health of that kind of lower end consumer that's being much more choiceful based on cumulative inflation, concerns about unemployment, and other affordability issues. What we're watching out for is the other half of that, or the other side of that K, which is the upper end consumer, which has enjoyed the benefits of rising financial asset prices, rising housing prices over the last several years. So can that continue into 2026? Or does that become a new group of customers that we need to be concerned about?
David, I mentioned at the top, you're down in Orlando, you're at the ICR conference, tons of retailers and consumer brands gather there. Any emerging trends that you're seeing in day one down there?
I don't know that I would say that we see a lot of emerging trends. I think that individual companies are focused on their individual initiatives. There's not a lot of talk about the environment, and what that tells me as a trend is that the environment is quite difficult to read. Consumer sentiment, consumer health continues to be a bit challenged, but yet a lot of the numbers that we're seeing in terms of consumer spending aren't reflecting that challenge. The high-end consumer, which represents the bulk of consumer spending, is still performing well. And frankly, what we think that we're seeing is the American consumer likes to spend in spite of, or maybe because of, their declining sentiment. It's just what we do as Americans. We like to shop. And I think as we approach 2026, there are a lot of questions as to whether that relationship, declining sentiment, but okay retail results, whether that relationship can continue.
David Silverman of Fitch Ratings, I heard yesterday self-gifting is in, so to speak to that trend as well. Definitely seeing that. David Silverman, thank you so much for joining us.
Thank you.
Coming up, slow hiring doesn't mean job growth has disappeared. Where there are still opportunities with mobility and security, we will tell you next on Market Catalyst. Despite slowing hiring, there are still job opportunities in America. A new report from Indeed highlights the best jobs in the U.S. for 2026 that are positioned for long-term mobility and security in the future. Joining me now is Laura Ulrich, Indeed Director of Economic Research. And Laura, I think safe to say there is a lot of interest in this kind of information, particularly right now in what feels like quite a slowing job market. I guess I would ask, first of all, how you define best jobs, right? What kind of criteria you used when you were trying to ascertain what these would be?
Yeah, absolutely. Thanks for having me today. So A best job, it would maybe mean a little something different to everyone. So we try to use some broad criteria to define our list. And basically, we're looking at pay, so the median pay of the job, but also how those wages have grown over the last 3 years, demand for that position, so current postings and also growth in postings over the last 3 years. And then lastly, we do include remote work availability. So we know workers do prefer flexibility overall. So we have that as a part of the formula as well.
Laura, I guess I shouldn't be surprised by this, but it is pretty remarkable how many healthcare-related jobs are on this list. And indeed, that's the area where we've been consistently seeing hiring.
Absolutely. I think this, supports the data we've seen from the BLS this year in the payroll employment reports and in our Indeed data as well. Our job postings remain quite high in healthcare fields, and you will see on the list 40% of the top 50 roles that we call out are in healthcare, and especially there's a lot of demand in like mental health care, rehabilitative care, and skilled nursing.
I'm also struck, though, there are a handful still of tech jobs, right? I see data scientist on this list. I see solution architect, although I'm not sure what that means, but I know it's techie. How much do you account, and how do you account for AI disruption to some of those roles?
Great question. So certainly tech is in a slow period in terms of hiring overall. However, when we apply our methodology for this, there are some tech jobs that still do kind of rise to the top 50. And it really is about jobs that are specifically about AI themselves, or also are these specialized roles. So like SAP consultant, data scientist, as you mentioned. And for many of these jobs, I mentioned we do consider remote availability as part of the formula. These roles tend to have a relatively high score in that category.
And the top role that we see listed there, cardiac medical tech. I think one of the other interesting things about many of the jobs on these lists is they don't necessarily require a 4-year, college degree, right?
Correct. So about 20% of the roles on the list do not require a 4-year college degree. And I will say, if you read our methodology, we intentionally leave out roles that require more than 7 or 8 years of school. We don't want to say like, oh, all the best jobs require you to go to college for 10 years, right? And so there are jobs on this list. And one of the pretty close to the top is owner, operator, or truck driver, which certainly doesn't require a 4-year degree. Other of these medical positions might require a 2-year degree or just some sort of certification. So yes, there are quite a few jobs that don't require a college degree.
I guess the other piece, the other question that occurs to me as I look at all of these is, okay, so these are the jobs. Are people training for these jobs?
That's a great question. And I actually, in my own research as an economist, do a lot of work in the community college and technical college space. And yes, they are. If you look at enrollment in both healthcare fields, but also the skilled trades, so HVAC tech is one of the jobs on our list, certainly CDL programs, you'll find wait lists at many of the community colleges around the country in these programs, because these programs are actually pretty hard to scale for the colleges, right? They're expensive to operate, and so they're difficult to scale. So there are people that have been listening to this mantra kind of over the past few years about how there are good jobs out there that don't require a 4-year degree, and they are trying to get these certifications.
So it's interesting because when we have this whole discussion about supply and demand in the labor market, and there's a lot of argument that supply is the problem, what you're saying seems to sort of bear that out.
In certain fields, I think right now it's clear, like, if you look at the payroll employment reports in 2025, demand in like business and professional services, for example, does seem quite soft, and you do not see many of those jobs showing up on this list this year, right? And demand in places like healthcare are stronger because of demographic shifts and other things that are going on in the marketplace. But labor supply is quite constrained in some of these jobs. And so, yeah, I think for some sectors and for some roles, it's more of a labor demand story, but in others, it's certainly labor supply is a big part of the story.
Laura, really interesting research, really interesting list, and hopefully we'll give people some help as they're trying to figure out where they should be looking. Thank you so much. Appreciate it.
Thank you.
That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance is coming up.